Welcome to week 2 of the accounting presentation. My name's Nigel, and the course this week is going to talk about accounts preparation and accounting controls. So just a brief summary of what we discussed last week, just to reiterate. The whole point of accounting is that we're making sense of chaos, understanding about cash flows, and in particular, we're trying to find out how much money has a business or an organization made or lost in the accounting period, how much money can be drawn from the business, and how much money is going to be needed going forward to continue with the organization or to continue to trade. And there were 2 types of transactions that businesses need to know about. One is the cash movements during an accounting period. I'll just say that one more time. It's during an accounting period, because for accounts to make sense, you have to know over which period you're doing the accounting. And then we also want to know what are the assets and liabilities at a particular point in time. So when we're making sense, that's what we're making sense of. And in order for something to be useful, we create accounting categories. And those categories need to make sense for the organization so that you can understand what's happening in the organization. And the categorization changes depending on what the organization is. So that was last week's course. The topics this week is about how we compile accounts, how we manage errors and set up accounting controls to minimize errors, and something called an audit trail. And an audit trail is something which has a much greater significance than it may seem, but it's all about how you track individual transactions once you have compiled everything together, and it's how you get back to the original transaction and the documentation that relates to it. So, compiling accounts. There are 2 types of accounts that we prepare. One of them is accounts for management. And the idea of management accounts is it's to take the accounting information that we've compiled and collated and present it in a format that the managers of an organization, a business or a charity, can understand how to change what they're doing in order to improve outcomes. So management accounts are very much for management or for anybody managing the business, but that's distinguished from statutory accounts. And statutory accounts are accounts that are more aimed at people who are assessing a business from outside. And typically, the way the capital society works is we have a whole load of shareholders who are not involved in managing the business. And what's important is that they are informed about how well or badly a business has done and how much assets or liabilities they have, so that they can make sure that management are using their funds appropriately, and that if they're making profits, they know how much the value of their business is likely to be. So they may want to sell their shares or to invest more money in the business. And the idea of statutory accounts is to create a standardized set of accounting so that investors and other people, for example, banks, can compare accounts from one business to another and know that they're consistent. We'll explain that in a bit more detail. But an example of statutory accounts, the 2 types of accounts that we are creating is one was the flow of funds during an accounting period. So in this case, the accounting period is for the year ended 31st of March 2021 of, in this case, Sunshine Traders. And in statutory accounts, you're required, for example, to say who the accounts relate to, what the accounting period is, and you're even required to say profit and loss account if you're in the UK. Other countries have different requirements, and you have to compare the current period with the previous period. It's a statutory requirement. You have to disclose income, talking about sales or turnover, different types of income. And the income itself is defined in law as to what you have to include. And the reason being that if I've got accounts for Sunshine Traders and I want to compare them with a set of somebody else's accounts, I want to know that I have some level of consistency, that when I'm looking at income and sales, I'm looking at the same thing between different companies or different organizations. So statutorily, in the UK, there's a certain set of accounts for small businesses. There's a certain format which are much more complicated and much more detailed for public companies. There's a separate set of accounts for charities. So in law, there's maybe half a dozen different types of accounts that you have to prepare. And the idea of them, as I said, is that they're consistent from one company to another. So, as I said, in a statutory account, you have income, cost of sales, which gives what's called a gross profit. We'll explain that a bit later. Various expenses, which gives you net profit of the period, net profit before tax for the period. In this case, it's for the year. Tells you what the taxation is, how much profits you made after tax. Again, this is a statutory requirement. How much dividends you paid, and how much money is retained in the business after you've made your profits and after you've paid out the dividends. So that's the cash flow during the period. And the balance sheet, the assets and liabilities at the particular point in time, in this case is as at the balance sheet date, which is the 31st of March 2021. Just want to draw attention to the fact that in the profit statement, we had accounts for the year to the 31st of March 2021. And we could have had a balance sheet for any period at all. We could have done the 31st of December, but we're required to have a consistent balance sheet date to coincide with the end of the accounting period that we've just done the accounts for. So it seems pretty obvious, but actually it's not quite so straightforward. And sometimes people you're explaining accounts to might not recognize this. And an example of when this might happen, when they might not figure it out, is if you're explaining accounts to management. Typically, the profit and loss account, my experience is they'll understand what we mean about the accounting period. But what they're less likely to recognize is that the balance sheet may not be the balance sheet as at today's date. And typically, if there's a very large transaction that's changed, and the bank balance, for example, is very substantially different from it was at the balance sheet date at the 31st of March, maybe we're talking to them in the middle of April or middle of May, they may well forget that we're not talking about today. So sometimes it's important, particularly if you've got managers that are not that familiar with accounts, to just draw attention to them about what the accounting period is and the balance sheet date is, particularly if a lot has changed between then and now, because as I said, in my experience, at some stage, a manager is going to misunderstand the figures, and that could cause some problems at a later date. So when we compile accounts, we're looking at the management accounts and the statutory accounts. And what I want to do now is to show you how to prepare accounts based on the spreadsheets that we prepared last week. Okay, so last week we talked about how we categorize expenses based on what the business needs are. We picked a cleaning business. One of the people attending this course is running a business, a cleaning business. So I thought we'd use them as an example just to illustrate what we're this income and expenditure account. And some of you will have done the exercises and created something similar to this. You might have come with slightly different income categories or expense categories. But in this particular example, we created income categories and expense categories. And the totals are listed down here. The total of the income for the business was £2,100 of business income, £300 of residential income, and various expenses, materials, rent and rates, utilities, and travel. And although this is a small number of transactions, exactly the same principle applies even if you had 5,000 transactions, that you're putting them together in categories and getting an overall total. So if you've got just a very small number of transactions, sometimes this is actually enough to show as accounts to somebody. But typically, we need to create a more sophisticated layout to make it a bit easier. The reason this is probably not a good layout is there's too much detail. And if you're showing management these figures, the chances are they'll probably home in on this and say, oh, that's spelt wrong, or that can't be right because. And if you're trying to explain to management about what the accounts show, you don't want them to get into that level of detail. So even in very simple accounts, you normally want to have a format that's laid out slightly differently. And this is just a very good format to as an example. And you'll notice there's 3 categories of profit and loss account. Again, I want to stress, in this case, we're doing it for the month to February 2021. So again, it's really important that you identify what the period is, because again, management, if they're looking at the figures, may well misunderstand. If you're showing them figures for 3 months and they think it's a month or vice versa, you can actually have some misunderstandings going on. So it's really important when you're doing accounts, always to set out what it is that you're showing, what the accounting period covers, and what period it ends to, just to avoid doubt. And as I said, if you start to feel you're talking at cross purposes with management or with anyone else looking at the accounts, you can very quickly draw their attention to the dates if necessary. But there's 3 separate categories we've got. One is an income category. One is what's called cost of sales, and one is administrative expenses. And I just want to talk very briefly about the difference between these 3 types of categories to try and give an understanding for what happens if you've got different types of businesses. So in a cleaning company, our income is pretty obvious and straightforward. It's business sales, residential sales, and interest. So if we have any of that in this business, we have that's income, not really much to discuss about it. But if this was a charity, what would you show as a charity's income? Is a donation income? Or is a donation different from an income? If a charity, for example, has both donations, if you imagine Kew Gardens charges people to go in and look at the gardens. It also gets donations. So I think it's pretty obvious that the receipts for going into the Kew Gardens would be income. But what about its donations? Would donations be income? Or would donations go in a separate area? So rhetorical question, because it's a bit difficult to get interaction. I can see a few of you are sort of answering the question, albeit on mute. That's great, I'm glad you're doing so. Typically with a charity, yes, donations are treated as income. And what I'm trying to distinguish with this is that income is not necessarily what you've earned. It's the money that's come into a business during an accounting period. Now, some charities may not want to show donations as income. They may want to distinguish the, if I call it the trading income from the donation income. So it would be completely appropriate, for example, to add in a few extra columns. And you might have, for example, donation income and trading income. You might have donations and legacy income. So you might want to distinguish this in a particular type of entity or a business. In a charity, you might want to do this. But we're dealing with a conventional business, and the conventional business really just has income. That's pretty simple and straightforward. But what I wanted to show is that you've got a lot of flexibility to highlight things or to change the way layout is set out, depending on what you think is important in the business. And when you're talking with management, if they start to talk and ask you questions to delve into, to drill down to a particular type of information, you may want to reconsider the layout. And you've got the complete flexibility. And this is an example. The reason I'm doing this on a spreadsheet rather than a computer is it's easier to see this happening on a spreadsheet than in computer accounts. but exactly the same happens in computer accounts. So the trading income, I think, is fairly simple. A bit more complicated is cost of sales. So I want to look at 3 or 4 different types of businesses to illustrate the issues with cost of sales. In a cleaning business, the cost of sales are the materials you use when you go to a premises and you clean. So for example, if you've got cleaning materials, detergents, you have to go and you take cloths, you use the cloths and you throw them away at the end of the period, particularly under COVID, you may not want to reuse a lot of material. There's a lot of variable stuff. And the only time you spend money is if you're going to do a job that you're earning income for. So the idea of a cost of sale at one level is, this is income, this is expenses you've got that relate to particular jobs. So I know one of the people attending this course makes films. So with a filmmaker business, the income would be when you sell royalties, you sell films, you show films on Netflix, that would be the income. Your cost of sales would be what you pay out to make the film. And the idea is that there's a direct relationship between the cost of sales and the sales itself. So I know a number of people here are involved in the property industry. So in the property industry, you'd probably have rental income as as your income, and a cost of sale might be utilities. In order to get rents, you may pay out some, at the premises, you may have to pay some electricity costs, and you may recharge your tenants. So you might have rental income here, recharged utilities here, and one of your cost of sales might be the utilities which you spent at that property for which you've got rental income. So as I said, the idea of cost of sales is to get a direct link between what your income is and what your costs are to get that income. And one of the reasons this is quite important, if, for example, you're a professional business and you're selling people's time. So I was an accountant, and we used to have income from the people our professional staff would be charged at, and we'd pay people who are going out and doing the work. And in a lot of industries, the ratio between your costs and your sales are a very useful indicator as to how well your business is doing. So in an accounting practice 20 years ago, you used to try to get, if you spent £100 on paying staff, you try and get income of £300. There's a 3-to-1 ratio. If you have a restaurant business, your income would be the receipts for a restaurant. The cost of sales would be the cost of food. And typically in a restaurant, you want a 2-to-1 ratio. It could be 3-to-1. And there's a lot of sophisticated discussions that go on relating to that. But what you're trying to identify is your direct costs of sales. And that's distinguished from the third category, which are either called administrative expenses or sometimes they're called fixed expenses. And the general concept of administrative expenses is that you spend this money whether or not you have income. So for example, if you're paying rent, if you're a shop and you're paying rent, it doesn't matter if no one walks through the door or 1 million people walk through the door, your rent is fixed. So if you're a restaurant, for example, you might be selling, getting receipts for when people come in and buy food, and your cost of sales are food, the food itself. But whether or not someone comes in, your rent goes into your fixed costs or your administrative costs. People use different terms to mean the same. People use different terms for the same thing. So it's really just what you feel comfortable with and what your management feel comfortable with. And the reason why this is so important is that if you have fixed costs, you know you have to earn a certain amount of money just to break even. So I'm going to put a few numbers in, and then we'll come back and discuss that very briefly. But I'm now going to populate these accounting formats, and the categories that I've used were the categories that we chose when we decided to categorize the accounting. So we've already been through that process. We then put them into this slightly revised format. And what I'm going to do is I'm going to take the figures that are in my spreadsheet and put them into the management accounts. So what I could do is remember that this for total business income for February is £2,110. So I could type in here 2110. But I don't know if you're anything like me, the chances are you'll make a mistake when you do it. What I'm going to do is create a formula that says, put into this cell whatever's in this cell here. And the way I do that is I type the equal symbol, which means I'm about to put a formula in, go to the categorized transaction, find the cell that I want to transfer the figure for, and it puts the figure in directly. I'm not going to talk about that, the mechanics of that, because I think most of you understand that, but there's a separate video on how you use spreadsheets. So I'm just going to much more quickly now go through and do that with the rest of the figures. So materials, travel in is a different column, so just need to be careful about that. Administrative expenses, the rent rates, utilities, and other. Okay, so we've now got this format that's, I think, quite easy for most people to understand. Most people, if you showed this, even if you didn't explain it, would get it. But I want to highlight that we've created these administrative costs or fixed costs. And in this particular example, I just had an additional error, so I just fixed the additional error. I'll come back to that in a minute. In this particular example, we've got £600 of costs, and by and large, every month we're going to have something similar. So the question is, do we have enough income from our normal trade to be able to cover that? So I'm going to very slightly modify this spreadsheet. I'm going to create a subtotal to create something called gross profit. The gross profit is the difference between the income and the direct cost of sales. So the formula is simply add these all up together. I'm just going to create a line above the subtotal just so that you can tell it's a subtotal, and then revise this formula. Right, so what I've done is I created an interim line called gross profit. This is in the restaurant business, this would be the difference between my receipts in the restaurant and the food I've had to pay out. Or in the cleaning business, it's the difference between what I invoiced and the cost of my materials. Or in my rental business, this would be the difference between my rental income and what I had to pay out directly to keep that rental income going. So I might have paid management expenses, somebody to manage the property for me. And the question is, are these gross profits more or less than your administrative costs? So from the management accounts point of view, we've now created a very simple format which took the figures from our spreadsheet, from our categorized spreadsheet, and we've flowed them through to these accounts. Just to summarize where we've got in terms of the bookkeeping, we started off with these unprocessed transactions. We categorized them into appropriate categories. We've put them into a format, and we've now created our first set of accounts. So I'm afraid we've run out of time to do what I wanted to do. So I'm going to touch very briefly on a couple of points, and I think we're going to have to deal with them in next week's session. But one of the things that may well have happened is we've got profits and loss of £300 here. I can just tell you, because I did this by intent, one of these columns doesn't add up properly. So these accounts are going to look correct, but they're wrong because one of the formula I've inserted is incorrect. So whereas accounts are relatively easy to prepare, and for the people that are new to this altogether, I hope you recognize that in 2 weeks you've already learned how to prepare accounts. As a bookkeeper, almost as important as preparing accounts is understanding how to stop errors arising. Because the worst thing you can do in accounts, particularly accounts that look professional, and these will look pretty professional to anyone that you give them to, is to have figures in there that are incorrect. So in next week's session, we're going to talk about how you set up accounting controls, how you manage spreadsheets, what sort of errors that can come in and how you prevent them. And one of the most important accounting controls, really of any that you have anywhere, how you reconcile these figures here to a bank statement, because the easiest error of all is if there's an entry on your bank statement that you've forgotten to transfer to these unprocessed transactions. There'll be an exercise. I'm going to have to slightly modify the exercises now. An exercise about preparing your own set of accounts. And I might give you a bit of an introduction to some error accounting so that you're prepared for next week's figures, next week's course. Thank you for joining me. Just to remind everyone that these courses are being uploaded to the Sunshine Courses website, where they'll be available, as well as the exercises, as well as the presentation. I'm afraid you didn't see the beginning of the presentation, but the presentation will be available for you to download. So thank you for joining me this week, and that's the end. We'll hopefully see you next week.